Good evening. Students, we will be discussing the short-term financing strategy, which mainly involves working capital management, If I refer to the study pack, it's chapter 14. Chapter 14, you could refer page number 393. So if you want, chapter 14, page 394, 43, yeah. So this is basically the chapter which will be discussing the working capital management. Before moving on to the area, just ask yourself, in the investment appraisals, whatever stage, maybe in the final level in even my session or even earlier, if you have looked at investment appraisal, the topic, we always have the cash flows reflected year by year, the future cash flows reflected year by year in a project appraisal. So, for example, you would say year 1, year 2, starting from year 0, year 3, like that goes. So, we will have to, in the investment appraisal, we have to put the cash flows into the years, right. So, you have to identify the relevant year and show the cash flows. So, when you say initially say land and building investment, you will say land and building investment year 0 X amount, you would put it. Similarly, if you can recall working capital investment, I am sure most of you all would remember working capital investment. Where do you show? You will see that it mostly in year 0 or it can be even year 1. You would see generally, those are the general situation I am talking. In a long term project appraisal, in an investment appraisal, you will see that land and building investments in year 0, year 1, you would say there is a construction taking place, then you will have the cash flow over the 2-year period. Land mostly in year 0, you will show it as a cash outflow. Working capital investment, we go and show in the year 0, maybe year 1, maybe couple of years, you will show the working capital. So, if it is a longer term project, 10 year, 20 year, whatever longer term project, say let's say you are talking about year 10 year project, at the 10th year, this working capital investment, you will show it as a recovery. If you could recall your knowledge of the investment appraisal, the working capital investment that you showed in year 0, year 1, you would show in year 10 as a recovery, At that time, you wouldn't have probably understood or maybe would have thought too much why this is shown as a recovery in year 10. Truly speaking, the amount of money you invest in land and building, the land and building will be there even 10 years or 20 years later, you will have value for the land and building. Similarly, the working capital investment that you make, when I say working capital investment, it will involve inventories. Inventories can be various types, raw material inventory, finished goods inventory, work in progress inventory, even spare parts, right. Those all inventory, you will say those are called inventory where you invest money. That investment, you invest in run the business. While you are running the business, the inventory and debtors, all these balances where you have invested will get converted into cash in a short period. So, the inventory gets sold and then you get the cash. Similarly, when you give the debtors the credit period, they will pay you. Then the credit will be, basically you have collected your money. So, what happens? These inventory, debtors, all balances get converted into cash at a short period of time. Again you reinvest on the inventory and debtors. So, it is a cycle. Every 2 months, every 3 months, you will be continuously do that. Even the suppliers credit also, you would be paying them regularly, you will pay every 2 months or 1 month you pay, again you purchase, so again pay. So, this is a continuous story. So, when you take the working capital total picture, you do the investment at the beginning and maybe due to the growth of your company, you will increase the investment in working capital over the period of time. That depends on the organization size and the nature. So, you will increase. So, when you increase the working capital investment over a period of time, the amount of money you have invested is there in your inventory, debtors, bank balances, creditors balances, all there. This cannot be taken back from the business because your business is running continuously. So maybe if it is a 10-year project you are talking, 10 years time you are talking about you closing your business. 10th year you go to your business, showroom, stores, everywhere and see what are the inventory you have got. What are your debtor balance at that day. So you would see that those can be realized now. And when you decide that your company closing down, 10th year you will recover all your investments, all your working capital investment. So that is the time you show it as a receipt or recovery of your cash flow which you have invested at the beginning. So this is what you have done under investment appraisal wherever you have studied in the previous stages or in final level when we discuss about investment appraisal, we would have taken the investment in year 0, 1 all that initial period and you show the recovery at the later period. So this is a normal thing. This is a normal thing. What I would like to say is keep that in mind because you would have known this transaction in the investment appraisal where you are shown as the investment and you are shown as the recovery. You have done that. Now we come to the what is the working capital management. Before that, what is working capital? Working capital means your liquid resources which are available in the company to run your business day-to-day basis. So your liquid resources available in the company to meet your liabilities, commitments, day-to-day basis is called working capital. So what are your working capital items? Generally inventory. The main item is inventory. Inventory you can have categories, raw material, WIP, work in progress, finished goods. So those are three subcategories of inventory. Generally you will have in the manufacturing organization, these three inventory types are there. But if you take a trading company, you will have only the finished goods. That means you buy and sell, you import and sell. Then you have only the finished goods. Maybe a service organization, you do not have really the inventory seriously. In the sense like large amount you don't see in inventory. Maybe you will have certain amount of stationery, spares, that kind of small items you can have as an inventory. But you don't have a business purpose, main business purpose, trading or maybe manufacturing types of inventory in a service organization. So inventory is one item. Then debtors. Debtors is outstanding. Debtors is outstanding from your customers. You have sold goods, customers are supposed to pay you, so that is outstanding. So that is the debtor balance. Then you have your cash and bank balance. You would see that your company would have cash and bank balances. Most of the time you will see those are your kind of liquid cash, liquid bank balances which are available to meet your day-to-day payments. And then we will have creditors, suppliers, creditors. So these are also part of inventory or what you call working capital. So these items are working capital items. So these are you show in the financials accounts as working capital items. Generally we show it in the current assets and current liability, but these are all working capital items. You might have say accrual, you might say prepayments, all that also fall into your working capital because those are the current assets and current liabilities. But these are the key items: inventory, debtors, cash and bank balances, and overdraft. If you say the bank balances, I can say the overdraft also, right? That is also part of your liquid resources. So these are all falling into the item called working capital. So what we are trying to say, the organization in order to run the business on a day-to-day basis needs to invest in working capital to meet the day-to-day commitments. So whatever the resources value you have in the organization to meet day-to-day commitments is called working capital. So whatever X amount you need to run your day-to-day commitments or meet the day-to-day commitments, then it's called working capital. How much is that? So maybe 5 million, sometimes it's 2 million. So you have a amount requirement, that is working capital, which you have to invest at the beginning of your business. Even if you say you are going to starting a small shop, still you have to invest for that working capital amount. Even if you say a larger supermarket, there you have to invest in your working capital. If it can be a larger manufacturing plant organization, where you need to invest in working capital. So amount of money you invest in working capital needs to be at the beginning you invest, and while you run your business you will continue to increase the amount of investment. And this investment value you can recover or realize only at the end of the project. If it is a 10-year project, you have to wait for 10 years. You cannot recover it earlier. Even though you sell your inventory, get cash, it doesn't mean that you have recovered your investment. If anybody think, okay, once you sold the inventory, you got your money, yes. But in a running organization, going concern business, that money again you reinvest in your business. So you don't take it. As an owner, you can't take the money out of the business. So it's a continuous thing. So the amount of money you invest in working capital at the beginning will be recovered only at the end of the project, So these are items which falls into the working capital item mainly. You can think of accrual, prepayments, even other assets, other liability, all are working capital item. But these are key items: inventory, debtors, cash, bank, overdraft balances, creditors. Okay. So what is working capital management? Working capital management is an activity or process, you can call it, which ensures that actually the management is ensures sufficient liquid resources are available to meet day-to-day commitment. Please make sure you understand this. Working capital management is all about ensuring, in the organization you ensure you have sufficient liquid resources are available to meet day-to-day commitments. So it's important that you understand your day-to-day commitments have to be met. It can be day-to-day commitments, when I say it can be your salary bill, staff salaries, or electricity, utility bills, and your supplier payments. It can be your security cost, rent cost, it can be statutory payments, it can be bank loan repayments, all are your day-to-day commitments. So during a period of time, if you look at, every day you need money to meet these day-to-day commitments. It's not about capital expenditure we are talking. It's about the day-to-day running your organization, you need to find money. So the process of ensuring that you have sufficient liquid resources available to meet these day-to-day commitments is called working capital management. Why I am trying to say this, even though people think that working capital management is a small area in terms of syllabus, and maybe it's not a very serious item or serious thinking you need to make on this, but to be honest, comparatively, the working capital management is so important area in organization or business, because if you don't meet your day-to-day commitments, you will be in a serious problem than you making loss in your organization. If you make a loss in the organization, still you will be running the organization. Why? You don't have a problem with working capital management at the beginning. Still you are a loss-making company, but you can run it. But when you say you have a problem with working capital management, that means you don't have sufficient resources to pay day-to-day commitment. As I mentioned the example, you couldn't pay your salary bill. Staff are working or factory workers are working, you can't pay their salaries. How long you can wait? Just think how long you can wait. You have not paid your electricity bill, you have not paid your rent, you have not paid your security bills, you have not paid your supplier, you have not paid your bank. All these day-to-day payments, if you don't pay, each item you write down and see how long you can delay these payments. How long? I am sure like electricity bill 2 months, they will cut your current bill, or electricity is cut. If your electricity is cut, no factory, no production, no business. Okay. Then if you don't pay salaries, maybe the couple of months you can delay, and still the employees will work for the company saying that loyal, we have been paid by this company all these years, so we should wait for some time. That is for short period, couple of months. After that, what happens? The employees say, no, we can't work, we need salaries, otherwise we will leave the company. So you start seeing all these problems. Supplier, if you don't pay your supplier 2 months bill, 2 purchases you have done and you have not paid your supplier, what happens? Third month, supplier will not give you goods. Then you can't manufacture, you can't sell your goods. So the supplier will stop supplying goods to you. Bank, you have to pay the interest cost, capital repayment. If you don't pay couple of months, unless like COVID-19 where we got the moratorium for most of the businesses, they would say like, okay, you have got moratorium, then you are delaying your payments. You have time to pay later. But if you take a normal situation, if you don't pay your bank loan, capital or interest for some time, what the bank does? Bank will repossess your asset, or they will start executing the parate by selling your assets to realize their loan outstanding. So please note all these day-to-day commitments, if you don't meet within the shorter period, right, you can't delay longer. Maybe 1 month, 2 months, 3 months, that's it. After that, all your normal operation gets stopped. Your people don't come to work because you are not paid salaries and you are not paid the electricity and utility bills, no current, no water, you have a problem. Then you will see that you are rented premises if you are in, if you are not paid your rent, the owner will say, no, you can't stay here. Bank, if you don't pay, they will stop your operation. So all the people will have a negative reaction. So what is going to happen? Within short period, you will come to a point where we can't run the business. That is the problem where we are talking as working capital. So if you don't manage your working capital properly, you will get into problems whatever I mentioned. But if you are a loss-making company, maybe a loss-making company can be running for 1 year, 2 year, 3 years also. Provided somebody is funding or you have excess capital already. Even though you have excess capital, you are losing money. But still you can lose for 1 or 2 years because you have excess capital. Or if anybody is pumping you money, you will be surviving. Like the government organization, sometimes you see certain government organizations loss-making. Couple of years or more than longer they would be making losses. But still they are running. The organization is not bankrupt, not closed. Why? Simply because treasury or the government is pumping money. So as far as the government treasury pumps money, the organization can run. So that is where we come to working capital. As far as you are having no problem with working capital, even though you are loss making, you can run your business. On the other hand, you are a profit making company, profitable company, and you have a problem with working capital. You don't have cash. Maybe you would have seen these construction companies. Maybe you would be seeing the profits are there, but they may not have it in cash. It may be in outstanding. The buyers have to pay you, or the certain other things outstanding are there. So what happens? You can't run your organization. Even though profitable, you don't have cash. So working capital is the so important area. Please make sure that you understand. More than profitability, working capital management is so important than the profit management. Even at a loss you can run the organization, but not at the working capital problem company for shorter period. Shorter period you will get into serious problem, you cannot run the organization. So this is basically the reason or the importance of working capital management. Why? It can lead your company to bankruptcy in a shorter period. So as I mentioned earlier, ensuring sufficient liquid resources are available to meet day-to-day commitments. So day-to-day commitments, you ensure that you have enough liquid resources, then you are managing your working capital properly. Okay, so that's about working capital management definition per se. Then we look at the working capital. When I say the inventory, debtors, all these things, this working capital investment, is it a short-term investment or long-term investment? short term or long term? Question mark. If I ask this question, whether the working capital investment is a short term investment or long term investment, generally we think the working capital item like inventory, debtors, creditors, bank balances, cash, all these are what? In your balance sheet, where do you show? Current assets, current liability. What is our understanding about accounting? Current assets, current liability both are short term, within 1 year, short term assets, short term liability. But really look at it, even though these are in accounts, we show it in short term assets and liability, that is because you will convert your inventory into cash within a short period of time. Debtors outstanding, say X is outstanding 10 million, that 10 million you will recover in 2 months, that means that is collected in 2 months. So on that basis, the accounting framework has established that all your current assets and current liability. But from the financial management point of view, our topic point of view, our subject point of view, working capital investment, whatever you are making an investment in working capital, the money you invest in inventory, debtors, outstanding, you have put the money there. This money what you invest, when do you recover your money? At the beginning I started saying that the money you invest, you don't invest to recover in shorter period. Like a land and building you invest, which of course you think okay it's a long term. But even working capital, even though it looks like a short term thing, it's not short term thing. It's a long term thing. Why? Once you put your money in inventory and debtors, you cannot take the money back. As an owner, I can't take my money back until I come to a decision of closing my business, winding up or liquidation or close my project. When I decide to close my project, only I can go and take my money back from the working capital investment. So please be aware that working capital investment is not short term, it's long term. Very important. There is a very important learning you should have, because most of the time we think, since it's in accounts we show in current assets, current liability, we think it's always short term. But it's not short term, it's a long term. It's a long term investment. Why? Once you invest, you can take the money only at the end of the project or winding up of the project. That's why earlier when I started my discussion today, I said your investment appraisal, working capital investment, where do you show? Year 0, 1, 2 maybe you would have shown. When do you show the recovery of the investment? Only at the end of the project. 10 year, 20 year, whatever period you are finishing a project, at that point you recover your investment. So that is where your recovery takes place. So that's why we say working capital investment is not a short term investment, it's a long term investment. Then if you take working capital, why the organizations have different amount of working capital. If you say X and Y, two companies, you would realize this working capital may be 10 million, this working capital may be 15 million. 10 million, 15 million. If you say the X has invested in working capital 10 million, Y has invested 15 million. Why? Why two organizations' amount of working capital differ? The reasons are various, right? Reasons why working capital investment differ from organization to organization. It's not the same amount you invest. One company invests more working capital, the other company invests low amount. What are reasons? One, nature of the organization. Nature of the organization. As I mentioned, manufacturing organization tend to have high amount of working capital investment compared to service organization. Manufacturing organization, as I mentioned, you will have various types of inventories, you have debtors, your spares, bank balances, all together you will have a large amount of investment. Whereas if you take the what you call service organization, you will not have the inventory category. Inventory category, if at all, it will be spares and inventory, what you call stationary stocks, which could be the small amount. So generally you will see service organizations have less amount of investment in working capital compared to manufacturing organization. So, that is one thing where nature of organization determine the amount of working capital. Second, your production cycle. You would see that the production cycle of your organization also determine the amount of working capital you invest. If you have a larger production cycle, that means you have to have a lot of working capital investment in terms of inventory. And if you are shorter, very fast, you can have you put your raw material, you get the finished goods in a shorter period, maybe 1 day or maybe hours, then your amount of money you invest in working capital also lowers. So, the production cycle is another reason. Third, your credit policies. You would see that organizations have credit policies. Company has given say 2 months credit to customers, and maybe another company has given 1 month credit to customers. So, you have to see that one company has given 2 months credit, other one has given 1 month. The person who has given 2 months credit will have a large outstanding in your debtor outstanding compared to 1 month credit company. So, you could see there is a difference. 1 month credit company and 2 months credit company. 2 months credit company will have more outstanding in debtors than the 1 month credit outstanding in debtors. So, that is also one reason, credit policies. It can be a debtor credit policy or supplier credit policy. Even the creditors would have given you half a month credit, sometimes it can be 1 month credit. So, depends on the credit policy, your amount of working capital investment also vary. Fourth, the organization would decide, right? It's the what you call the management approach to risk. Management approach to risk. But there are organizations who are risk takers. There are organizations who are not risk takers, they are risk averse. So, the company which won't like to take risk will have a lower value of inventory and working capital. The company which wants to avoid risk, right, they don't want to take any risk, they will have enough inventory in their showroom, factories, and they will have enough bank balances so that they don't have to return any checks. So, they have enough inventory so that their manufacturing process will continue without any problem. So, their approach to risk also determine the amount of working capital. So, please note that working capital investment value will differ based on what is the approach to the risk your company has. So, there is another reason why the working capital vary. Fifth, so nature of the organization, production cycle, credit policies, management approach to risk, and the size of the organization. Smaller company will have small amount of working capital investment, larger company will have large amount of working capital investment. So, these are some of the characteristics or the factors which will decide the amount of working capital in the organization. Okay. Nature of the organization, production cycle, credit policies, management approach to risk, size, which determine the amount of working capital your company should carry. Then the working capital management, when you take, you have this cash operating cycle. Cash operating cycle. So, what is cash operating cycle? You might see the study pack also, page number 396. It talks about cash operating cycle. It's actually you buy the goods, say you are buying the goods and you start manufacturing, or maybe you can straight away say you have sold it, sold, buy the goods here, you sold it here, then you collect the money, collect the money. So, buying goods to sold, there is a time period. This is called your inventory holding period, inventory holding period. From the time you sold till you collect your money, this is called debtors collection period, debtors collection period. Your bought goods, you have to pay your supplier. Assume that you have paid your supplier. This is your supplier paid. Supplier is paid. So, from the day you purchase till you pay your supplier, it's your creditors holding period. Creditors holding period. So, please note, you bought the goods and you sold. So, the time gap between you bought the goods to sold is called inventory holding period, how long it takes to sell. From the day you sell on credit and you collect the money after some time. So, that period is called debtors collection period. Then at the same time, from the time you bought till the time you pay your supplier, at this point you are saying supplier is settled. That is called creditors holding period. So, there are three time period we are talking. One is the inventory holding, how long you keep the inventory with you, and you collect the money, how long it takes to collect the money from your sale of goods, and how long it takes to pay your supplier from the day you purchase the goods. So, what is cash operating cycle? It says from the time you pay your supplier, or in the process of this trading, your time you spend money, from the time you spend the money and the time you collect the money. So, your supplier payment is done here and collect the money here. So, how long? How long? That is called cash operating cycle. So, how do you calculate inventory holding period plus debtors holding period minus creditors holding period? This is called cash operating cycle. So, please note, inventory holding period plus debtors holding period minus creditors holding period is called cash operating cycle. I think page number 396, you can see that as an example to calculate the cash operating cycle, which says that company buys raw material from suppliers that allow 2.5 months credit. That means your creditors credit period 2.5 months, and the raw material remain in inventory for 1 month, raw material remain in 1 month inventory, and it takes 2 months to produce the goods. So, we are talking about raw material supplier gives 2.5 months credit, that is your supplier credit, that I said supplier credit 2.5 months. Average time raw material remain in inventory is 1 month, and it takes 2 months to produce the goods. The goods are sold within a couple of days of production. So, they are saying that after you produce the goods, it takes only few days to sell. So, it is not very serious number of days. Customers take 1.5 months to pay. Okay. So, you have, if you take the time intervals, raw material holding period, raw material inventory holding period, raw material inventory holding period is 1 month. 1 month. If you take it months, 1 month. Then time taken to produce the goods, it takes 2 months to produce the goods. So, your production or WIP holding period 2 months. It takes 2 months to produce the goods. Then after producing couple of days time you are selling. So we are ignoring that couple of days because it's not significant number. So we remove. In case they say like it takes 1 month to sell your goods, then it's a finished goods holding period, you have to add it here. So in this case finished goods holding period we have not taken 0, but you might say take it if you are given a significant number of days. So you have to add the raw material holding, WIP holding, finished good holding, we have added. Then it takes 1.5 months for the customers to pay. So your debtors holding period 1.5 months. 1.5 months. After you manufacture the goods, it takes 1.5 months for the customers to pay us. So the credit period given to customers is 1.5 months. Then time taken by the 1.5 months. Then we minus creditors holding period. Creditors holding period. Creditors holding period is 2.5 months. 2.5 months. So these are the number of days involved. What we are trying to find out from the cash operating cycle is from the time you made the payment to your supplier, how long it takes to collect the money from debtors. From the time you pay your supplier, that is first payment you are making to supplier, from that date, how long it takes to collect the money from debtors. So on that basis, 3, 4.5, 2.5 you minus 2 months. So your cash operating cycle is 2 months. Cash operating cycle is 2 months. So that's basically how you calculate this cash operating cycle. So even in the exam, the examiner can ask you to calculate cash operating cycle by calculating these periods, raw material period, inventory holding, debtors holding period. You have to calculate one by one, and you have to add the all raw material inventory, WIP, the finished goods, debtors holding periods you have to add minus creditors holding period. Okay. So that's basically in page number 396, you can look at it. Then there are two approaches in working capital management. There are two approaches in working capital management. One is called conservative, other one is called aggressive. Conservative approach and aggressive approach. So what is conservative, what is aggressive? As we know that normally in English, conservative means you are not a risk taker. You are basically careful, right? You don't take risk unnecessarily. You take more precautions than you just go and take things as it is. You will be careful. So that's a conservative approach. Aggressive approach is where you take risk. You take risk in managing your working capital. So these are two approaches companies are having in deciding the working capital management. So here risk averse, here risk taking. Risk averse and risk taking. So conservative approach, you will see risk averse, aggressive approach, risk taking. So there are two approaches. This organization can decide. Now you might ask the question, how do we decide, or what is the best approach? Is it the conservative or the aggressive? There is no answer as saying like, okay, conservative is better than aggressive better than conservative. Why I am saying, it all depends on how you are or what kind of person you are, what kind of company you are. The company is a person who wants to take risk in running the business. He doesn't mind facing the risk. Then you will take the aggressive approach. But there are organizations who are very careful. They are very conservative. They don't want to take unnecessary risk and they manage a business. If that is the case, you take the conservative approach. So what do you mean by this? Conservative approach, if you will have enough inventories. Enough inventories. When I say enough inventory, you would invest in your raw material, WIP, finished goods, sufficiently you invest. Enough. That means, for example, in a production flow, while the manufacturing takes place, the flow should have enough raw material. While going through, suddenly you see there is enough demand for the goods, so you want to manufacture continuously. And there are a lot of demand, so you are manufacturing more and more products. At that time, you need enough raw material. So in order to get the raw material, if you don't have enough raw material in your production flow, what happens? Your production will get stopped. So to avoid that, you should have enough raw material. When you have enough raw material, your production process will not get stopped. But what is the disadvantage? If you are having enough raw material for which you have to invest money. So there is a negative side, that your investment in money is much larger than used to be. But this positive side is your production flow or the production facilities will be operating without any disturbance. So that is what the enough inventory is, plus and minus. Similarly, you will give higher credit period debtors. To debtors you will give higher credit period. You will give 2 months credit or 3 months credit. You have given enough debt outstanding. So you are given that. Then you will see the creditors also, you will have lesser creditors, conservative. You will pay on time the creditors, don't delay the payments. And you have bank balances, you will have very high bank balances. Why you do that? Because if there is a payment to come next week, you will have sufficient money in your bank account. You will not have minimum balance, you will have maximum balance. So you will release checks, say for 5 million worth of checks you release, but you will have bank balance say 10 million. You don't need to do that, but you will have. Why? You are conservative. You don't want to feel or you don't want to face a single check get bounced, single check get returned. To avoid that, you will have enough bank balances. So these are the few examples. When you say you are conservative, what do? You have enough inventory, you give higher credit periods, you have enough bank balances, you have lesser creditors outstanding. So this is basically the conservative approach. When you do this, plus is what? Plus will be, you will not have shortage, no shortage. It can be production flow, it can be showroom, no shortage. You will not have any shortage in your production flow as well as in your showrooms. If you say showroom, assume the situation where last week before the new year, if everyone was going to shops to buy goods, right, and you walk to your showroom and you see there is a limited stocks available. You want various varieties and you don't have it. Then what happens? You are not happy with the showroom. And not only you are not happy, you will tell few people to say that it's not available. Any business you can think of, any product you want to buy on that during that period, you go to that place and you see that they don't have enough stocks. What happens? It's a negative impact. That sale is gone, future sale is gone, and the goodwill of the company gone. So all that is a negative impact. So no shortage. If you have conservative approach, no shortage. You will not have shortage of production flow, not in the showroom. So no shortage, so you will have good name in the sense your negative name will not be created, good name will be there, and you will have more sales and profits. So these are pluses of the conservative approach. Minus, conservative approach minus is, main minus is your investment opportunity cost or holding cost. We call it holding cost. Since you have to invest a large amount of the working capital, your money is tied up in working capital, which means you have a higher holding cost. So the holding cost is a negative thing. Holding cost is a negative thing. Positive sides, you don't have any shortage, no problem at all, right? You can produce goods as you want, and your showrooms, everybody who comes to the showroom will be able to buy goods and go. Nobody will turn out to say that I don't have goods in the showroom, and your checks will not get bounced. So these all have positive impact. So that's the positive sides of the conservative approach. Negative side is mainly the money invested. Your money invested in working capital, high amount of money you invested, that means your profits will come down. Your holding cost will eat into your profits, so your profit comes down. So actually the problem is profitability have a negative impact. Profitability will have a negative impact. Conservative approach, the profitability have a negative impact because you will see that your holding cost is higher, even though there may be no one in your showroom to buy goods, but you have enough goods in your showroom. So that also have an impact. So these are conservative approach, plus and minuses. Same thing, we look at the aggressive approach. What is the aggressive approach? Aggressive approach, like earlier I mentioned, the conservative you have enough inventory. Here you have a limited inventory. You don't have enough, you have limited inventory. Debtors, you give debtors lower credit period. Debtors, you have a lower credit period. Creditors, delay. You will try to delay your creditors. Bank balances, low amount. Lower bank balances. You don't have excess bank balances, you have low bank balances. So limited inventory, you have a lower inventory in your production flow. It can be raw material, you have a limited inventory. Finished goods, showrooms, you have a lower inventory or low amount of inventory. And debtors, you give a lower credit period, don't give a grace periods. Creditors, you will delay your suppliers' payments, and your bank balances, you have lower bank balances. So this is an aggressive approach. What are plus and minuses? Just think on the same line. Here, since you have limitation, you will have one negative stock out. Negative situation is stock out. You will see that you have stock out problem. In your production flow, you will have stock out. That means stock is not there, then you will have a problem. What is the problem? If you don't have raw material sufficiently, production flow suddenly have to stop. Production facilities will have to be stopped. That the people who are working in the production flow become idling. So stock out, idling labor, idling machine. Why? Your raw material is not there, therefore your machine is idling, otherwise the machine can be working. Because as you know that machine has to be continuously working, so that you have to reduce your cost of production. But if you don't do that, idling labor, idling machines, stock out, all that are available. Negative situation of the aggressive approach. Then it can be your showroom stock out. These are raw material stock out. Showroom also you can have stock out. Showroom in the sense sales stock out. Showroom stock out, which means customer comes to your showroom and he sees there is no sufficient goods to buy. Then what happens? He turns out. He can't buy the goods in the showroom, he is going out. When he goes out, you lose your sale, you lose your profits, you lose your future sales, because he will go and tell many people that your company or the showroom doesn't have goods. So these are the showroom stock out situation. Raw material stock out is production issue, that is idling labor, idling machine. Finished goods to showroom impact will have to be understood, because you lose the sales, you lose your profits, future sales also. So these are the minuses. So we need to understand aggressive approach have some positives and negatives. Similarly, we looked at conservative approach as positives and negatives. Now you could see both have plus and minus. So when you say both are plus and minus, what is the best one? But the conservative approach is the best one or aggressive approach is the best one? You need to think that. It is up to the organization who to decide whether conservative or aggressive is better. Most of the time people think that conservative is better. Why? You are not taking risk. You are very safe. You are not taking risk, you are safe. But to be honest, there are people who like to take risk. There are people who like to take risk because they will be able to save money. Right? They will be able to save money. As I mentioned here, the negatives here, the conservative negative is the holding cost. But aggressive, this is negative, positive is lesser holding cost. Lesser holding cost. Aggressive approach, positive, main positive is lesser holding cost. Why? You don't invest much in your working capital. You reduce your investment in working capital. That is the aggressive approach. So by doing that, your holding cost is saved. The positive side is that holding cost is saved. So someone say, no, I would like to take risk. I don't want to put enough inventory in showroom because I don't get all the customers to buy my goods. There are only few people buy. Even if they buy, I have reasonable or sufficient, I think sufficient. So if there is excess, if people don't buy, all that money I have invested in working capital will be wasted. So better I don't take enough inventory in my showroom or even the raw material. Even the bank balances, I don't want to keep enough bank balances. I would like to keep minimum bank balances. If I am giving 1 million rupee check, I will have 1 million rupees bank balance. I don't want to keep 3 million bank balances. Why should I keep 3 million bank balances? So these are the things you think in deciding an aggressive approach. So the question comes always, what is the best one? Conservative or aggressive? My answer is, it is the attitude of the organization. Attitude in the sense, the attitude towards the risk. Whether the organization is a risk-taking organization or the company is a risk-averse organization. If you are a risk-taking organization, you will go with the aggressive approach. If you are a risk-averse, in the sense your mindset is that I don't want to take risk. I am very careful. I would want to be very safeguarding my organization shareholders' wealth. Then you go and take the conservative. So this is how you decide. The organization has to go to decide whether I am conservative or aggressive. I am sure like even in your exams, how many of you all will be carrying 2 calculators? 2 calculators for the exam. You might be thinking joking. No, seriously. There are people who take conservative people who take the 2 calculators. Why? In case one calculator doesn't work in the exam hall, what is the way out? You have another calculator. So that's a conservative approach. You are taking lesser risk. There are people who take only 1 pen to the exam hall, 1 pen. Right? There may be people who will be taking 1 pen. Only 1 pen for the entire exam. Why? They are people who are aggressive people. Aggressive approach. Aggressive means risk taking. They think that 1 pen is sufficient. I will not have any disturbance during the exam hall, the exam period. With 1 pen I can manage. So I am taking that risk. So majority will say no, that's bad idea because you have to have 2 pens at least. In the exam hall one doesn't work, other one is there. That is conservative. So conservative and aggressive is that. So there are people who are conservative, there are people who are aggressive. Similarly, even organization, there are conservative organization, aggressive organization. Even the organization, certain decisions they will be conservative, certain decisions they are aggressive. So please note, these are the relevant facts you to decide whether you want to go on the conservative approach or aggressive approach in managing the working capital. So that's basically the approaches on working capital management. In terms of working capital management, 2 other things is costs. You have, one is called shortage cost, other one is called holding cost. So in your managing working capital, you would see that there are 2 types of cost, shortage cost and holding cost. So shortage cost is where, as we mentioned earlier, when you happen to have the aggressive approach in managing the working capital, you try to have limited number of inventory or limited amount of inventory. So when you have that, you are going to face shortage. Because there are say 100 people have come to buy the goods, you have 80. Only 80 products you have, but 100 people have come to buy the goods. So 20 goods you can't sell. That's shortage. That there is a cost you are going to incur. What is the cost you are going to incur? You lose your profitability of the 20. If you add the 20, you would have got the money also, profits. So you are losing. So shortage is that. Shortage cost is your loss of profits. Loss of profits. So that's the shortage cost. Similarly, in the production flow, as I mentioned earlier, if you don't have enough raw material, your production flow also will get into shortage of the raw material. There is a cost involved there. Idling labor, idling machinery, whatever. You have lost the production opportunity, or basically you would make profits from the sale. All that becomes shortage cost. Holding cost is the opportunity cost of your investment. Holding cost is opportunity cost investment. If you say you have invested 10 million rupees in inventory, 10 million rupees inventory, say 20% holding cost, 20% holding cost. So if you have 20% holding cost, 10 million investment, you incur 2 million. 10 million investment you have made and 20% opportunity cost. 10 million you have invested, 20% you have opportunity cost means 2 million you are incurring. 2 million you are incurring as opportunity cost. So this is holding cost. So there are two types of cost, shortage and holding cost in working capital management. So when you see that if you are going to manage working capital at the optimal level means that's the best level you should be maintaining in your organization. By doing that, you will be able to minimize the total cost. Minimize the total cost. Because what happens generally, if you put in the graph, more you invest in working capital. If you say this is a working capital investment value, more you invest in working capital, you will see that your holding cost will be increasing. More you invest in your working capital, your holding cost, or you can say cost here, this holding cost will increase while the working capital investment goes up. Working capital investment. So working capital investment 10 million, 20 million, like that it increase, holding cost increase. The more the amount of investment, more the holding cost. Shortage cost. More you invest, you are going to have shortage cost. So your shortage cost will be opposite direction to your investment value. More you invest, lower shortage cost. Lower your investment, higher shortage cost. So you can see that you will have shortage cost goes against or the opposites of the working capital investment. Holding cost goes on the direct line, or maybe you can say that it's on a positive note, where more and more working capital investment, more and more holding cost. So if you can look at it in the dotted form, this is a total cost. Total cost. So you can see here this point is called optimal amount of working capital. Optimal working capital. This point, this is the total cost point, minimum point, that's here. You can see the point here, that's your optimal working capital. So your optimal working capital, you can see that if you manage your working capital at the optimal level, you will have the total cost at the lowest. Total cost at the lowest. Please note this. So you have to understand that depends on the amount of money you are investing in working capital, these two costs will vary. Holding cost and shortage cost will vary. Okay. Then when we say working capital, we have something called permanent working capital and variable or temporary working capital. So you have two types of working capital: permanent working capital, variable or temporary working capital. So what is this permanent working capital? The amount of working capital your organization should be carrying throughout the period. Even though you might see the seasonal variation in your business. Say during April New Year season last week, everyone knows that there are enough businesses, there had been higher amount of inventory, right? More outstanding, more debtor they would have been selling in credit. If the company is selling on credit, more outstanding debtors, and inventory, when you take more inventory, and you would have carried more bank balances. So you would see that your investment in working capital during the April and December season, Sri Lanka, we all know the April New Year, December Christmas holidays, 2 seasons we generally have more sales happening, more businesses happening, more activities. So that period your inventory and debtors, your working capital will be very high amount. But if you take the period, say you see the working capital amount, you will be having like straight line, and you see then again like this. So you see this is the period, this period you can see April, this period you can say December. Maybe here January, February, maybe October, November. So you can see that your working capital goes high like this period, other period it will be maybe straight line, or maybe a slight up and down. So these 2 periods are seasonal. These are seasonal periods. So working capital investment also will be more in the seasonal periods. April and December, if you take any businesses, it could be textile, it could be electronics, it can be food items, you would see more inventory or more working capital investment during this period. Other periods, it's more or like the same. This more or like the same is the permanent working capital. Why? The amount of money you invest will be maintained, or your investment will be there throughout the period. This is called permanent working capital. Variable or temporary working capital is the amount of working capital you need to carry in order to meet the seasonal demands. So it can be April, it can be December. During the seasonal demand period, you invest more into this working capital. This period you will invest more working capital. So you need to understand there are 2 types of working capital: permanent working capital, variable working capital. Variable working capital is mainly for the seasonal period. Permanent working capital is for your throughout 12 months you will carry that. Why we need to divide these 2 very clearly? Permanent working capital is a long-term investment. Variable working capital is short-term investment. At the beginning of my lecture discussion, I said working capital investment is a long-term investment because it's not a short-term. It will be recovered only at the end of the project, or 10-year period, means 10-year period. Now we are little more we are learning, where we try to say true that working capital long term, but there is one component called variable component which is short term. That is a short term investment. The balance majority portion which will be there throughout your 12 months, that's called long term investment. So please be aware the working capital investment or the working capital items, there is a great amount of component long term nature. There is a smaller component as a short term nature. So as an investment point of view, this is short term nature investment, this is a long term nature investment. Can you take down this? It has to be very clearly known to you, because when it comes to the latter part you will see that your differentiation is important, and even in the when you are working environment you need to know this, because your short term investment has to be financed only for short term. You don't need to finance your short-term investment for long-term. Because April, if you need money or investment, you need to find the money only for this only month, 1 month. You can borrow for 1 month, buy the goods, sell the goods, in April end, you settle the loan. Same thing December. December beginning you borrow the money, buy the goods or give credit to customers. 1 month's time you recover the money and settle the borrowing. So you need to understand that these short period investments have to be financed by the short term financing. Short term financing. You don't need the long term financing. Okay. You might see this about just calculation per se, gross working capital and net working capital. Just differentiation between two terminologies. Current assets, total current assets is called gross working capital. Current assets is called gross working capital. Current assets minus current liabilities is called net working capital. Current assets is called gross working capital. Current assets minus current liability called net working capital. Net working capital. So please note the difference, because sometimes examiners give you the values and you to ask how much gross working capital or net working capital. So net working capital is current assets minus current liability. Gross working capital is current assets. Okay. You might take page number 406 in the study pack. It's about early settlement discounts. Early settlement discounts. What is this? Early settlement discounts. You have to understand, generally when we give credit, say today 0 day and say 30 days credit. Normally the company would give credit period to customers, say 30 days credit you are given. So you basically have to wait, for 30 days to collect the money from debtors. So your money is tied up in your debt outstanding for 30 days. Once you sell the goods today you are selling the goods, till the customer come and settle you. It takes 30 days. If you are given 30-day credit period, it takes 30 days to settle your outstanding. So 30-day period, you are stuck. That means your money is stuck in your debt outstanding. Till the money comes, you cannot buy again or reinvest in your business. So how do I get the money faster? I need to give credit to customers, because industry in which you are working must be giving credit to customers. So when the industry is giving, you cannot avoid that. You also have to give the credit to customers. So when you go to give credit to customers, you are agreeing that we will wait for some time to collect the money. That's fair enough, because that's basically the norm in the market. But by getting money earlier, you have advantage. What is the advantage? The earlier you get the money, you are able to reinvest in your business. You can buy goods again you sell, you can make more money. Turning around your business transactions more and more, you make more and more money. So what I have to do, I have to get the money early. Get the money early from my customers. So my customers, I am going to tell them, if you are going to settle, say within 10 days, if you are going to settle my money, I give you a discount. Now the question comes, whether it's a trade discount or cash discount. Trade discount means, in order to sell your goods, if you are giving discount, it is called trade discount. Now you go to a showroom to buy goods and they say, okay, if you buy 5 items, I can give you 10% discount. Whatever the item. You want to buy 5 items, I will give you 10% discount. But if it is 10 items, I will give you 20% discount. So what is this discount? trade discount. Trade discount. Why? In order to increase the sale, the discount you give is called trade discount. But what we are talking here is not about the trade. We are talking about cash discount. This discount is called cash discount. Why it's called cash discount? In order to collect money in advance from the debtors, we are giving discount. So we are basically encouraging the customers to pay early the money so that he gets discount, so that he is induced or motivated to pay early. Here it's not about sale. Sale has taken place already. 0 day, you have sold it on credit, 1 month credit. After selling, you tell the customer, if you pay within 10 days, I will give you 10% discount. So this is called cash discount. So the organizations can give you cash discount to customers. Now the cash discounts, we need to evaluate and see, is it worth it or not worth it. Sometimes the cash discount is not beneficial to the organization, sometimes it's beneficial to the organization. So our question is how to evaluate this early settlement discount. How to evaluate early settlement discount. So could I ask you to look at the page number 407 of the study pack. 407 of the study pack. 407 of the study pack. If you read it, it's 5.5 example. LP company annual credit sales of 12 million. Credit sales 12 million. And the 3 months are allowed for payments. So you are giving 3 months credit. 3 months credit. Company decides to offer a 2% discount for payments made within 10 days. So company is going to give 2% discount people who are going to pay in 10 days. So company is going to pay or give discount of 2% people who are pay within 10 days of the goods sold. Maximum time allowed for payment is 2 months. So maximum credit is 2 months. This is actually after the new scheme is introduced. New scheme is that you give 2% discount for payments made within 10 days and to reduce the maximum time allowed for payment of 2 months. So earlier it was 3 months, normal credit period 3 months. This is a new proposal. New proposal is anybody who pay within 10 days he gets 2% and your objective is to give maximum credit period of 2 months. It is estimated that 50% customers will take the discount. 50% customers will take the discount. If the company requires 20% return on investment, of 20%, what will be the effect on the discount? Assume that the volume of sales will be unaffected by the discount. So please note, you have credit sales 12 million. You have annual credit sales of 12 million. Generally you give 1 month or 3 months credit period. So they are now thinking, there's a new proposal, we give you 2% discount people who settle 10 days time. In the same time, maximum credit period we will give you 2 months. So we need to evaluate whether it's worthwhile or not worthwhile. And they say the required rate of return of the investor is 20%. Required rate of investment return is 20%. Okay, so let's look at if the volume of accounts receivable or company policy remains unchanged. If you say your old policy, we will just take it old policy and new policy. Old policy 12 million your sales, 3 months credit period. So your debt outstanding average 3 million. Your debt outstanding debtors is going to be 3 million. This is going to be 3 million. If you change to new policy. New policy, 12 million your credit sales, 50% of the customers, 50% of the customers will pay within 10 days. Plus 12 million sales, 50% of customers will take not 10 days, they will take 6 days or 2 months of 12 months, 6 days of 365. So you can see the numbers there calculated, 10 divided by 365, 50%, 12 million, here 2 divided by 12 or 365, 60 divided by 365, 50%, 12 million. So it's roughly your new debtor balance 1.16 million. New debtor balance 1.16 million. Here it's 3 million. Here it's 1.16 million. 1.16 million. So now you can see there is a reduction from 3 million debtor balance, we generally have 3 million debtor balance, has become 1.1 million. So we are talking about reduction in debtors. Reduction in debtors 1.83 million. 1.83 million. Reduction in debtors 1.8 million. 1.8 million. So the investor wanted 20% return on their investment. So what you have to understand that your debtor balance earlier normal credit period, if you are given 3 million debtor outstanding, that means you are investing in debtor 3 million. Throughout your outstanding is 3 million. You give a discount, 2% discount, your debtor outstanding will become 1.16 million. 1.16 million. That is, there are two types of debtors. One is 10 days debtors, that is 10 days time they are paying, so 10 days outstanding. 50% of customers only will take 10 days only outstanding. Other 50% will take 2 months to pay the outstanding. So their outstanding total will be 1.16 million. So your reduction in debtors is 1.8 million. Reduction in debtors is 1.8 million. So 1.8 million reduction in debtors, we have to understand this 1.8 million reduction in debtors, there is reduction in return requirement also. So we will see that 20% of this, how much my saving? 20% of this 367,123. 367,123 per annum I will have saving. Why? My debtor outstanding or debtor investment I have reduced, that will save 20%, my opportunity cost is 20%. So 367,000 I am saving. Per annum I am saving. Now we have to ask the question, this is a saving we are going to have because we have reduced the credit outstanding, reduced the working capital investment, by which I am saving on 367,000. Now, what is the cost we have to incur? What is the cost we have to incur? Holding cost saved. Holding cost saved by debtor balance reduced. What is the cost we have to incur? In this, how did you do this? How did you do this? You gave discount. You have a discount scheme. So how much your discount scheme? That's your cost. Your discount is the cost. Discount is the cost. 12 million, 50% their customers pay within 10 days. So 2% discount for that. How much? 12 million, 50% of the sales, 2% discount you are giving, which is going to be how much? 120,000. 120,000. So this is your discount cost. This is a saving of holding cost. So cost is 120,000 you incur to do this scheme, and you are saving, holding cost saving 367,000. So what is your net impact? 120 and 367, your difference is 247,000, 247,000, 123, that's your net benefit, net benefit. 367,000, 120,000, net benefit 247,000. So that basically tells us giving discount in this example is beneficial to the organization. By the organization will save 247,000. So this is the way of early settlement, discount. How do you evaluate? Cost is a discount, benefit is the holding cost saving. Why your debtor balance comes down, that means your holding cost will saved. Holding cost saving is your benefit, discount is the cost. Discount is the cost. When we calculate holding cost, there are certain understanding we need to get in the holding cost computation. For example, if I say I have inventory say 10 million and you have debtors 10 million, say 20 million total, and profit margin say 20% of selling price. And if I say the 5% included 5% value is depreciation of selling price. 5% of your selling price is basically represent depreciation. 5% of selling price represent depreciation. 20% of selling price is the profit margin. And if I say the required rate of return or opportunity cost is 15%. Now what is your holding cost of this company? You have inventory 10 million worth inventory throughout the year. Debtors you have 10 million throughout the year outstanding. Total 20 million you have working capital. Assume that's only working capital. This 20 million you invest in year 0. You will be having every year outstanding. So that money is invested. Your opportunity cost is 15%. So what is your holding cost for 1 year? Your holding cost for per annum is 20 million into 15%, 3 million. 20 million into 15%, 3 million. That's my holding cost. 20 million into 15%, 3 million is my holding cost. This is a normal understanding. We are believing that I have invested 20 million in my inventory and debtors and my opportunity cost is 15%. So my holding cost per annum 3 million. That's fine. But my inventory includes, I would say, just take this example on the other way, depreciation. Say depreciation of 1 million, depreciation of 1 million included in inventory and 1 million included in debtors. So we say that your value of inventory 10 million includes 1 million of depreciation value. That means you have allocated depreciation, a portion allocated depreciation to your valuation, and your inventory 10 million include 1 million depreciation. And 1 million include debtors. Your debtors 10 million includes 1 million depreciation. So these two are having depreciation component also. Now truly speaking, when I say I have 10 million worth inventory, Did I invest 10 million rupees cash in inventory? 10 million investment in inventory means, does it represent 10 million cash investment? Answer is no. Why? 1 million depreciation is just a book entry. We allocate that 1 million to the inventory valuation. Actually, we have not put money there. So, if you have not put the money 1 million, our depreciation is not inside, even though accounting point it's there, but cash point of view, I have not put cash in my inventory. So, actually, I have put how much inventory? Not 10 million. Cash investment, if you take cash investment, how much? Inventory 10 million, I have put only 9 million. 1 million is a depreciation only. Debtors, I have 10 million debtors outstanding. That 10 million debtors also, in my accounting or my costing, I have included 1 million depreciation also part of this 10 million, which is a non-cash item, no cash was invested. So, I have to understand 10 million includes 1 million depreciation, 1. Profit margin, 20% selling price. Your debtors outstanding 10 million, that has 2 million selling price margin, that is profit component. So, your debtors has profit component of how much? 2 million, depreciation of 1 million. So, total of 3 million I have included in my debtor outstanding. 1 million depreciation, as we mentioned, it is not a cash outflow. I have not invested cash, it is not my cash investment. But 2 million profits, is it my investment? Even though I invoiced goods to the customer saying that you have to pay 2 million, but does it mean that I have put money 2 million? Profit component is again my book entry or the invoicing, I am not really spending my money. So, actually speaking, 10 million includes 3 million of non-cash, 7 million only my investment, total 16 million. So, what is the holding cost? Your 15% opportunity cost of 16 million, which is 2.4 million. So, please note, holding cost, real holding cost on the cash investment, holding cost on cash investment, is 2.4 million, not 3 million what we computed earlier. What we computed earlier is simply when you take 20 million your inventory and debtors, your opportunity cost 15%, you have invested 3 million. But truly speaking, your cash investment is 16 million, not 20 million. So, 16 million you have invested at 15%, 2.4 million is the real opportunity cost. So, this is how you calculate cash investment holding cost. If you take your past papers or questions, you would see that sometimes the examiner does not differentiate this cash investment story. He will just ignore that and he just asks you to calculate the holding cost of your investment, and you will go on the normal basis of your outstanding debtor and inventory in the balance sheet, multiply by holding cost and say holding cost how much? 3 million. But reality, real life scenario, if you really look at it, you need to be aware that your inventory and debtor balances includes non-cash item. That non-cash item you have to remove when you are really calculating your holding cost. Why? If you are going for a bank loan or overdraft facility, you are not going to pay single holding cost or overdraft cost for the non-cash item, say depreciation and profit component. So, therefore, we ideally have to remove the profit component and the depreciation and calculate the holding cost. But if the examiner is not very clearly giving information, you might go with the normal inventory and debtor balance and calculate your holding cost. Then one of the other important thing on the working capital management, the concept called over capitalization versus over trading. These are two terminology, looks like the same, but they are not the same. One is over trading, other one is over capitalization. So over capitalization means excessively invested in working capital. Over capitalized. The company has invested excessively. Excessive means what? More than requirement, more than the requirement you invest. If you are invested more than the requirement, that is called excessively invested. So excessively invested in working capital is called overcapitalized. So you might have seen that the organization, company might need only say 10 million worth of inventory, but you have invested 15 million. You could have given easily 1 month credit and waited, but you have given 2 months credit to debtors. So therefore your debt outstanding very high. Your bank balance, you can have 5 million bank balance throughout the year and manage your working capital, but you have 10 million extra, another 5 million. These are called excessively invested. So overcapitalized is where you have pumped money or invested money heavily into the working capital. So you will see that as symptoms in the organization: more inventory, more debtor balance, lower creditor balance, more bank balance. These are the symptoms of your overcapitalization. So therefore you will have a current ratio and quick ratio. Current and quick ratio will be high. Because all of these are there. More inventory, more debtor, more lower credit balance, more bank balances. Therefore your current ratio and quick ratio, when you calculate, it may be 2.5 or quick ratio may be 1.5 or 2. It will be very high numbers. So this is what you understand or observe as symptoms when you say overcapitalized company. What is the disadvantage? Disadvantage is what? Holding cost. Since you have heavily invested, you have holding cost. You don't really earn. Out of that investment, but you are incurring a holding cost. That's why I told you, you may not need to give 1 month credit to customer. You are half a month credit, still people will buy and settle your outstanding. But you give 1 month credit. So the additional half a month you are given to customers will not give you any additional profit, but it will give additional cost. So the overcapitalization problem is the holding cost. Plus advantage. What is the advantage of overcapitalization? As we earlier discussed, no stock out. You don't have to worry about it. No stock out. And good image. Why? All the customers will say that when you go to that showroom, definitely you will be able to buy goods because they have enough goods in the storeroom. So that's a good thing, good image. You will create that. More importantly, overcapitalized advantage is no liquidity problem. Very important. No liquidity problem. Overcapitalization, you will realize no liquidity problem. Disadvantage is holding cost. Advantages are no stock out situation you will have. Good image you will create. No liquidity problem. Very importantly, no liquidity problem. This is overcapitalization scenario. So when you take any organization balance sheet, look at it, see whether the company is overcapitalized. So if you say, normally we say current ratio 2:1 is good. But if your company has 4:1, very high current assets. What do you mean by that? Overcapitalized. So you should know what are symptoms, what are advantages and disadvantages of the overcapitalization. Over trading. What is over trading? Faster or maybe sales grow faster without having sufficient long term capital. Sales grow faster without having sufficient long term capital. If you see the organization sales is growing faster without having long term capital, sufficient long term capital. If you realize, that's called over trading. So you need to ask the question, growing sales is good or bad? Growing sales is good or bad in organization? Generally when your sales are growing, it's good. Sales are growing means it's good. Why? You will have more sales, more profits. So obviously you are very happy about the sales growth. But what you are trying to say, the sales grow faster. Sales grow faster. Say 25% growth. When the economy or the country grow at 4%, 5% and your company sales are growing at 25%, what do you understand? Your growth is very, very high. Very, very high. True that you may be doing really good. That's why your growth is high. But at the same time, you need to ask the question, do you have sufficient long-term capital? Why? Any company to grow faster or more sales to achieve, you need to invest. You need to invest. If you are a manufacturing company, you need to invest in plant. You need to invest in the showrooms. You need to invest in inventory. You have to give more debtor credit period. So obviously you have to invest a lot to get more and more sales. Land and building you have to buy sometime, you have to buy factory, you have to buy machinery, you have to give credit, you have to have more inventory. So when you want to achieve more, very higher growth sales, you have to open showroom, factories, all that. So if you are going to do that, your sales will be growing, but you need to have investment. You have to invest long-term investments. So if you are going to invest in long-term investment, land and building, even the working capital, what we discussed, working capital investment is a long-term investment. If you are going to invest in all that, you need to finance those investments which are long-term nature. Land and building, furniture fittings, your machinery, your inventory, debtor balance, all are long-term nature. If you are investing in long-term nature, what do you need? You need to finance all these long-term investment with long-term financing. Long-term financing. So if your organization is investing long-term with long-term financing, no problem. Even at that time, you have a higher growth in your sales, it's a very good thing. But your sales are growing faster and you have long-term investment and long-term financing. But when you have a sales growth faster, underline the sentence, without having sufficient long-term capital. Because everyone knows that in order to grow faster, you need to invest. So as I mentioned, land and building, factory, machinery, inventory, debtor balance, bank balance, you have to invest. All that investments are long-term nature. So it's a good thing, you invest. If you invest all that with short-term financing, not long-term, short-term financing, then you are in overtrade. Right? Sales grows faster without having sufficient long-term capital. Without having sufficient long-term capital. Without having sufficient long-term capital. If you are having sufficient long-term capital, it's not overtrading. If you don't have, then you are having overtrading. That means, for example, in order to achieve say 20% growth, you have to invest 100 million. 20% growth, you have to invest 100 million. To invest 100 million, you need to finance. This is long-term investment, that 100 million long-term financing you need 100 million. If you don't have long term financing and you use short term financing, 100 million. So what is long term financing? If you are using the share capital money, or if you are using debentures money, or if you are using bank loan for a long period, then it's a long term financing because your investments are long term. If you finance through bank overdraft and you are going to use your creditors balances and you are going to take the short term loans, that's called short term financing. So if you are going to use short term financing to invest in long term, you are doing over trading. So over trading is a good or bad? Over trading, good or bad? Over capitalization we discussed. We said over capitalization, holding cost is the problem, otherwise you have enough liquidity. You have enough liquidity. Positive side is enough liquidity, but your holding cost is a problem. But over trading, what is the plus? What is the minus? Over trading. Plus is over trading, you have more sales, more profits, because you have more sales means more profits. Over trading, you will have more sales, more profits. What is the disadvantage? You will see you have short term financed your long term capital, which means you will have liquidity problems. Short run, you will realize you will have to face liquidity problems. This is the key disadvantage of over trading, liquidity problems. You are not able to meet your commitments. Why? You have borrowed short term, invested long term. When the bank asks for money in short term, you can't pay. When the creditor asks for money, you can't pay. Why? Your monies are tied up in long term investments. So you have liquidity problems. So here you will have profitability, but you have liquidity problem. Over capitalization, you will see they have over capitalization situation, you will see they don't have liquidity problem, but they will have profitability problem. So over capitalization, profitability is a problem, liquidity is very good. Over trading, profitability will be very good, but liquidity problems will be there. So keep that in mind, because most of the case study you have got to decide whether that company faces over capitalization or over trading. Based on that, your answering has to work. Okay. So these are important things. So you need to be very clear in what we have learned, right? So we will be talking about some of the other concepts also with the other topic on the working capital management. So please go through the study pack, as I mentioned, chapter 14, right? Please go through, there are examples given there that will help you to understand the topic better. Thank you.